Okay, good morning, everybody. It's 8 o'clock, so I think we'll get going. So thanks, everybody, for attending the 23rd Annual CIBC Western Institutional Investor Conference here in Banff. Very pleased to be joined by PrairieSky Royalty this morning. We've got President and CEO Andrew Phillips with us today. I think most members of the audience would know PrairieSky fairly well. I'll give Andrew just a couple minutes here to introduce the company, and then I'll get into a Q&A that I've got planned for him. And once again, happy to take questions from the crowd as we go along, so please raise your hand. There's also the app that you can submit questions anonymously if you want up here, and I'll try to get to them too. So we'll keep it interactive, and with that, I'll pass it over to Andrew.
Thanks, Jamie, and thanks CIBC for your support in hosting this year's conference in Alberta. That's great. CIBC's had very close ties with PrairieSky since our IPO. We thank them for their quality research, Jamie, sales and trading, banking, and ECM, so it's been a good relationship. PrairieSky is the largest fee simple mineral title owner in Canada with 15.7 million total royalty acres, ranging from southwest Manitoba all the way to northeastern BC. We attract approximately 5% of all the capital in the basin, so we're effectively a taker of activity in Western Canada, which seems to be coming off a trough right now. We've got a diverse asset base. We capture all plays and geographies. We have 325 royalty pairs, ranging from Royal Dutch Shell, ExxonMobil, right down to the smallest producers. We collect monthly income from 38,500 wellbores across Western Canada. We're a debt-free business that's returned $1.3 billion to shareholders, which is 35% of our current market cap, and we expect to return another $2 to $2.5 billion over the next 10 years, which is 65% of our current market cap. So there's very few businesses, debt-free businesses, that are able to return that much capital to shareholders. Our shareholders also have or own 850,000 acres in the fastest growing play in Alberta, which is the Clearwater oil resource play. And I'm just going to show, I know we have slides up here, I'm just going to show the one slide. And this really describes our business. There's 55 years on the x-axis, and you can see the long duration nature of our business. This is all the lands that you own as a shareholder. And every decade, you generate billions of cash flow, return to shareholders, and you still have the same great business. So again, over the next 10 years, we'll return somewhere in the range of $2 to $2.5 billion, which is 65% of our market cap to you, and you'll still have a great business in 2029. So it's a simple, old-fashioned business. It's unlevered, and I think that's one of the things when you walk down a comp sheet, you go, oh, that's a pretty similar free cash flow yield to a lot of these other midstream companies, but the reality is we're unlevered. So if you levered the business, obviously it'd be a lot higher, but we believe in better risk-adjusted returns. So that's just a simple overview for PrairieSky. I'll turn it over to Jamie.
Excellent. Maybe we'll kick things off with the type of capital environment that we're in for producers. So, the entities that, of course, are drilling on your lands. Certainly constrained from their side with respect to capital budgets. What are some of the things that PrairieSky is doing to entice drilling on your royalty acreage?
Yeah, one of the things we've been trying to do, Jamie, is offer royalty incentives for shale plays and new exploration plays on the front end, because a lot of these plays, you drill one good shale well, you can prove up 100 follow-on locations. So we are offering front-end royalty incentives for new drilling. The other thing that a lot of people don't understand about our business is we have about 12,000 square kilometers of 3D seismic data. So we offer that to all our producers free in exchange for signing a royalty arrangement with us. So that allows people to lower the cycle times and lower the costs of their exploration plays.
Maybe on that, like PrairieSky's got a unique perspective given you have such a big land base in Western Canada. As you mentioned, the Clearwater and Duvernay have been two plays that have merged out of the basin in recent years that, a lot of companies and investors didn't really see coming, right? Do you see any other prospects emerging that might be under investors' radar at this point? And if not, I guess how do you see the Duvernay and Clearwater advancing from here?
Yeah, and I guess on other plays, one very key play in our asset base is we have two thermal oil sands projects that represent about 13% of our net oil royalty production, and both of those are likely to grow this year. Both are seeing capital spend, so that part of the portfolio likely grows in 2020. And then as for new plays, there's a new Banff tight oil play that's been emerging in southern Alberta, and we've seen some spectacular results, sub-1-year payouts, and it's a light oil play. So there are new plays coming forward. And then in terms of the emergence, to answer your second question of the Duvernay and the Clearwater, I'll talk about the Duvernay first. It was zero production. We didn't even know we owned it. It was just it was undeveloped land at the time of the IPO, and a few people kind of identified that shale was in the right maturity zone. It now represents about $250 million a year in capital spend on our lands and 350 barrels per day of net royalty production. So that'll grow somewhere in the range of 50% this year, we think, based on the capital budgets we've received from the different royalty payers on that play. The play that's growing the fastest and is fastest growing play in Western Canada is the Clearwater. And it was something we just acquired 2 years ago. We recognized it as the fastest payout play in North America, which is why we made our entry into it. And it's currently 135 barrels a day, but it's growing at 100% CAGR every year. So it should be 250 by next year and then 500 the year after of net royalty barrels. So this is an asset that we spent $60 million on. It's probably worth, from what we know today, $250 million. It's probably a $1 billion asset in our portfolio within the next decade. So that's the most important play.
We've seen PrairieSky be acquisitive in the past in certain instances. If we think about the Clearwater, is that your most logical target to try and get bigger in, do you think? Or how should we think about some of the different M&A prospects that you might have on the come here?
Yeah, and I think it's difficult for us because we have you've got the Duvernay and you've got the Clearwater, and they're both at really early stages of development, so they're mostly just undeveloped land. So you don't get a lot of cash flow from them today, but they are growing at a very fast pace. So for us to buy something that's declining at single digits every year, it could dilute our asset base over time. So we're pretty picky as to what we'd end up potentially acquiring, but certainly more of what we've done over the last 2 years, which is acquire high-quality land pieces that are going to be developed in the near term.
Okay. We've seen some M&A taking place between operators in recent months. How has that impacted PrairieSky and some of the assets that you're exposed to, like Lindbergh and the Alberta Bakken at Ferguson, for example?
Yeah, so the Alberta Bakken acquisition, that's a great one for us. A little history on that. We've received $130 million in royalty payments from that since the discovery of the pool. So it's a very large oil in place pool. The company that was previously running it ran into a debt problem, and so it's now been acquired by a well-capitalized producer. Their plans are to triple production on the acreage over the next 5 years. So that's an excellent result for us. It's a non-dividend paying company, IPC, that acquired it. So these are great operators going onto these assets with better capitalization. It's quite often a very good positive. And then the other one is Lindbergh, which represents about 600 barrels of thermal oil sands production. And they had a big debt problem. It was acquired by Kona, and they, I think, did $650 million of equity. So that's a pretty substantial equity chunk. Took the balance sheets into pretty good position, and they've already licensed 14 wells on that property. So we should see an acceleration in the development of that play as well.
Great. PrairieSky's been debt averse over its history here. Should we think about the balance sheet being pristine going forward, or would you look to use debt for any acquisitions? And I guess on the other side of that, would you ever look in the U.S.?
Yeah, I guess on the debt front, we've never had long-term debt. We do have a $250 million bank line that we could use if something came up in the short term. But I think ultimately it would be short-term debt if we did use it, and we just pay it down with our excess free cash flow and slow the buyback down. So that's how we look at debt. It would likely never be a permanent part of our capital structure.
Right.
And then with regards to the U.S., when you step back and look at the macro, the U.S. is coming off a 35-year high in drilling activity and going lower, and Canada's inflecting higher off a 25-year low in drilling activity. So when you step back as a royalty owner, you want to be in the place where there's an inflection to the right way, and that's one of the struggles a lot of the U.S. mineral companies are having right now is rig counts are dropping. And in Canada this year, today I think I checked, we're running 263 rigs. Last year was 227. So our rig count's actually up this year. It's the highest it's been in 2 years. So we're starting to see a little bit of capital return to Canada, and we're seeing it fall off in the U.S. So certainly even if you were interested in the U.S., now would not be the time.
Right. Okay. We saw the government lift the ban on conventional drilling near the end of last year. You think that's led to some of the increases in activity we've seen on PrairieSky's land? And, I guess, what do you think about activity in 2020 in general with what you've seen so far?
Yeah, when we ran our internal budget, we kind of ran it in line with what 2019 was, which is going to come in at about $20 billion in capital, which is lowest in a decade. We think it might be slightly higher than that, but we're kind of budgeting for a lower level. It really depends on where oil price is. And I think, if you asked me 2 weeks ago, I probably would have said it'd be 10 to 15% higher than last year. But now with oil in the low 50s, it might come back to last year's levels. Right. So it's hard for us to predict, but.
Okay. I guess how do you weigh the uses of free cash? PrairieSky doesn't have, capital requirements necessarily. Of course, you do have to acquire some volumes to backfill other assets that are maybe tailing off in the end of their life. But I guess how do you weigh the different options of free cash flow for dividends, share repurchases, and M&A? This environment, I guess, and then just generally speaking, PrairieSky's philosophy on the use of those three.
For sure. So we generate a lot of free cash and we have no capex in the field, so we do have to return that capital to shareholders. And the way we've always looked at it is it's a great dividend paying company. It should over the next 20 years be a great dividend growth company. And then that excess wedge of free cash flow, depending on the environment you're in, you can use to cancel shares or make acquisitions. So we've been consistent with that. We've returned $1.27 billion to shareholders in dividends and buybacks. And the next 5 to 6 years looks like about the same. So we'll continue on that path, and I think as the free cash flow profile grows, we should be able to increase the dividend. This year, obviously, there's enough uncertainty that I don't think that would be reasonable, but we'll make that decision in February. But I think going forward, you can see dividend increases and using that excess cash to cancel shares below intrinsic value.
With respect to the three different commodities that you're exposed to, I guess, natural gas, heavy oil, light oil, and then NGLs in Western Canada, we've seen, a decent inflection in natural gas with respect to AECO pricing. Do you think that would drive, an inflection in volumes on PrairieSky's lands, or an inflection in activity on what you guys have, or, I guess, how do you think about those three different commodities going forward, and growth, prospects with respect to all three?
Yeah, and I think the one tailwind we have this year, and this first year we've been able to say this as PrairieSky, is we collect product revenue on three different royalty streams, so NGLs, crude oil, and natural gas. Natural gas is inflected higher. We're totally unhedged on natural gas. We've never believed in hedging. And so our natural gas portfolio is generating a lot more cash, triple the cash it was 6 months ago. So that's a positive. And what that also means is our oil and gas producers who have solution gas with their oil, or pure gas producers, are generating more cash flow as well. So we hope that translates into more spending, and certainly some of the producers like Tamarack Valley, who drills really good oil wells in southern Alberta, they also have a lot of solution gas with it that was almost nuisance gas, but now it's generating good cash flow. So potentially they can increase their budget because of that excess cash flow. On the NGL side, we're actually seeing an inflection. The contract year, most of you probably know, is April to April. And the April to April contract last year was very weak, so our NGL pricing was very weak. We're expecting it to be quite a bit higher this year, so that's another inflection on our revenue stream, so that should be a positive. And in addition, we used to be 25% of all the components, and now our pentanes or our condensate are quite a bit more of the mix, so we should see that improve as well. And then oil, it's a tough one, but it looks like about the same as last year.
Okay.
So 2 of the 3 are inflecting higher, so a bit of a tailwind on that front.
Maybe one thing that a lot of people aren't aware of is PrairieSky's got some pretty good exposure in certain areas of the Montney. Can you talk about those?
Sure.
Pipestone, and then I guess Doe as well.
Yeah, so Pipestone and Wembley, it was kind of a fun year for us for that. We had over 30 Montney wells drilled on our royalty acreage. A lot of them are kind of coming on late Q4, early Q1, and very, very strong results, and mostly condensate. So those will start to show up in the quarterly production results over the next few quarters. There are a number of follow-on locations. I don't know the operators' specific plans on those lands, so hopefully there's a continued development there. But probably the bigger piece is with Leucrotta. We acquired almost 2 townships of land and 2 rivers, and they made a very significant oil discovery right in the middle of our lands in that partnership. So there is a very large oil discovery on our Montney lands in 2 Rivers, BC, and I think that's probably where the big upside is for our shareholders over the next 5 years.
Great. Can we talk a little bit more about the Duvernay? I know we touched on that. I mean, it's been a bit slow to advance given some of the reduced operator spending. I mean, how do you think that play competes with some of the other targets that you guys see on your lands, I guess?
Yeah, I think, when you look at it directly against the Viking certainly has superior economics, and that's our best play, probably the fastest payout play in Canada for light oil. What we've seen in the play is there's everything from completely uneconomic wells, $10 million capital costs, and looks like it'll take 3-4 years to pay out, all the way down to 1-year payouts where Artis is having some success in the Ghost Pine abatement. So I think it's an early stage play, and it's kind of like year 2 of the play. And when you look at how the Permian advanced, and if you look at how the Eagle Ford advanced, these shale plays, it took them about 4 times the number of wells that we've seen so far in the Shale Basin before they finally took off and before they finally got costs down and EURs up. So it's still advancing. There are pockets that are already economic, but we'll have to see how it plays out. I think the costs have to come down a little bit.
On the Viking there, you mentioned, activity in the Alberta Viking has increased considerably in recent years and, remains relatively underbooked in your guys' playbook analysis compared to the Saskatchewan Viking. I guess, what has you excited here over the next few years, and what should investors be looking for out of that region in particular?
Yeah, there's a number of things that have happened on the Alberta side, and what makes Alberta unique is it's a higher quality reservoir, so you can actually water flood it and get real reservoir sweeps. So these are pools that should actually produce royalties for us for the next 30 years because of these really high quality water floods that people are doing, both Carve, Tamarack Valley, and a number of others. And I think, some of the most recent results we've seen is that the water floods have had exceptional results of sweeping the oil. And the last piece is Gibson built a pipeline into the region, so now the costs over the next 20 years will be quite a bit lower. You can produce these wells to a lot lower rates, so the economic limit gets pushed out. So we're excited about it because the Viking is, again, 3/8 of our oil production, royalty oil production. And that's an area where we see the reserve life index actually quite a bit higher than even the Saskatchewan side. So we're excited about that.
Should we think about the Saskatchewan side as more of a stay flat play for Prairie Sky and, a true cash flow, generator for the company, and the Alberta Viking more as the growth wedge? Is that fair to assume?
I think that's fair to assume, and Saskatchewan's interesting because we've got, in our playbook, we have 6,000 development locations outlined, and they were getting drilled at about 500 wells a year, so you had just over a 10-year inventory. Today it's about 400 wells a year, which keeps production flat. So we've got somewhere in the range of 15 years of inventory remaining in Saskatchewan to keep it flat.
Maybe we can just touch back on the Clearwater. That's a play that is held in the hands of a lot of private companies, so you don't see a lot of it in the public domain. I mean, Cenovus is hard to talk a little bit more about it as well, but can you just give us an update on some of the things that you see there out of the private operators that you're attached to, and some things that we should be thinking about in 2020 from that play in particular?
Sure. Yeah, and there's been a lot more exploration done, as well as a couple development pods. So right now, just to give you a flavor for the total production, I know Spur's producing 15,000 barrels. Delta Stream's producing 10,000 barrels out of the play. This is all from 0 2 years ago, to give you an idea of the scale. And this is without neither company has done an equity raise, so all internally generated cash flow. So there's 25,000 barrels amongst those two, and then it would be CNRL's the next largest, and then Cenovus is the next. But I think one of the things that continues to improve is the fluid systems they're using to drill these wells. And for those who aren't familiar with it, they're open hole laterals. So effectively, it's cold flow heavy oil. It's just light enough to flow on its own without SAGD. And so they drill between 4 and 6 leg laterals. And the key is not hurting the clays as you drill through the reservoir. So they've gone to 10% KCl or an inverted mud system. And both of those techniques have proved successful in not damaging the reservoir and getting great IPs. So I think the Cenovus had a well that came on in an area where most wells were coming on 150, 200 barrels a day at 600 barrels a day. So I think there's still continuous improvements in technology there with the drilling fluids. They don't require fracs, so there's no real cost inflation. And Spur's been drilling their wells for $1 million a well, getting their payout in 6 to 7 months, even with the diffs. So with that kind of a play, it's self-funding. They don't require equity. They don't require debt, and they can grow self-funded. So that's why we believe that'll continue to grow at 100% CAGRs.
In your playbook, you had the Nipissing and part of Martin Hills area is basically your development zone, and then the exploratory lands beyond that were basically free upside for future, playbook iterations. What have you seen on that development area so far?
Yeah, so there's been 10 exploration wells drilled on the greater kind of Doucette, which is kind of North Martin Hills all the way up into Evie Cadot. And I can't say exactly which ones they are because there's still some confidentiality issues, but 50% of them have successfully delineated large new oil pools. So we expect some continued development of those, and you'll see it in the well licensing is our expectation over the next year.
Got it. Chris, go ahead.
You sort of exist in a world where ESG is a big conversation, but you're a pure royalty company. Can you speak a little bit about how that whole ESG trend is affecting how you run your business? Can you just talk a little bit about that?
Yeah, and so the only place we could actually reduce emissions in our business would be at the corporate level, like our office, and so you can offset that with tree planting. But when you think about actual greenhouse gas emissions, all of our producers who produce on our lands, they account for 100%, even the royalty barrels. So we'd be double counting if we added them. So from an environmental standpoint, we're actually, we're almost a financial company. We just own the subsurface mineral rights. So we stand up very well on the S&G as well. And so I think we're doing more work on it. And by we, I mean Cam and Pam. And so we are going through and filling out the surveys, and we are getting very good scores on a lot of these fronts. And it's obviously becoming a bigger and bigger theme, and we're definitely focused on it.
Maybe on that's a good question, and it's come up in almost every panel so far, and it comes up in almost every discussion we have with investors. Like ESG is certainly gaining importance and relevance as far as how investors are allocating capital. I guess what are some of the key initiatives that PrairieSky might have that people aren't thinking about for 2020 on and I know it's a huge spectrum, but any two, I guess, initiatives that you might be able to talk about in 2020?
Yeah, I think probably the number one thing is filling out all of the different, trying to get into sustainability index. You got to go through all the different, there's the carbon disclosure project, all these different, and you have to just do the work to go fill them all out. And ISS, it is a little more challenging for us because ISS considers us a financial company when it comes to ESG. And so we don't have all the financial highlights, but also when people look at, when you're filling out a survey for E&Ps, they ask, what's your health and safety program in the field? And we don't have field operations. So you have to definitely do a little more work to make sure people understand what type of business you are, because they use a lot of AI just to screen for these things. But again, we're just going to continue to fill out the forms, and the great thing is we have great business from that standpoint, so we don't have to we just have to showcase what we actually have.
Gotcha. I guess maybe just switching back to some of the quarters in 2019, we saw, and specific in Q3, we saw prior period adjustments trend lower quite a bit for PrairieSky.
Right.
How should we think about that moving forward, and can you just sort of remind us on that front, what led to sort of the exception in Q3?
Sure, yeah. So prior period adjustments, 2 of our 3 months that we report in any quarter are accrual quarters. So we can accrue too high or accrue too low. So that's one place to get a PPA. The Q2 drilling was extremely low, and you also had breakup. So that resulted in very low PPAs. Those will recover over the next couple of quarters. We've had situations where we've had extremely high PPAs and big production prints, and we always caution investors those won't last forever. They'll come down to more normalized levels. So I think to answer your question, they should normalize to kind of where they trended in the 600 some barrel a day range.
Okay. I think we've touched on this a little bit already, but I'll ask it maybe a different way. We're in an environment where you've seen producer valuations at all-time lows, and it's been discussed in a bunch of other panels. It's a sort of a generational opportunity possibly for those seeking acquisitions. Should we think about PrairieSky being more active in 2020 in gaining royalties into different areas of the basin that maybe you don't have exposure to, or how should we think about that, I guess, with respect to the landscape, and then also PrairieSky's appetite to enter different areas?
Yeah, and I think we're always looking, and we're always interested in partnering with high quality operators that have good cost structure, good balance sheets, and good execution. So we've never wavered from that in good and bad markets. We're always looking for opportunities to expand our resource base. If it's again with the right play, the right payouts, and the right operator. One of the challenges we have is, we did the Canadian Natural Resources acquisition, which was $1.8 billion, and that took the two biggest fee simple land positions in Canada and put them together. And a lot of the things we look at on an acquisition front, they have a terminal value of zero ultimately. They don't have kind of the duration our business has. And right now the 6% free cash flow yield is really nice. The 182 million you'll receive in dividends is all really nice. But the reason you own the business is for this 10 million undeveloped acres, because that's what's going to create the cash flow in 2040. And a lot of these assets we look at, they have nice cash flow streams. They'd be accretive today, but they dilute the business 3-5 years out. So we're very, very picky as to what we would acquire, but certainly we're always looking.
Okay. Maybe last final question from me here. I'm an energy analyst and focused on mostly E&P companies, and Prairie Sky, of course, is focused on is effectively tethered to E&Ps, obviously, with what it does, but it is a much more unique model and does have appeal to different investors because it is not necessarily an E&P. I guess if you're given the opportunity to talk about the appeal of your business model to generalists, how would you frame it?
Yeah, and I think the simple way I would frame it is you've got a $3.6 billion business that if you take the trailing 5-year returns to shareholders in the next 10 years, your entire market cap, your entire enterprise value will be returned to you as a shareholder. And if you take any other business, Starbucks, Alimentation Couche-Tard, net off the debt, and then show the total returns per market cap, you'll never get to a number like that. And I think Canada's best producer was up here yesterday, Canadian Natural Resources, and they're very, very proud to say that over the last 5-some years, they've returned 22% of their enterprise value to shareholders in returns and buybacks and dividends, and ours is 35%. So it's a great business from a returning capital standpoint, but also from a risk standpoint.
Great. Well, with that, I think we'll cap it there. But Andrew, very much appreciate it, and thank you for the questions also.
Thank you. Thanks.
Yeah.